Hello, and welcome to the Kase chat session on December 24th, 2014. My name is Dean Rogers, and I'm the senior analyst here at Kase & Company. We all know that trading's risky, and what we're doing here in these chat sessions is showing you techniques that can help you improve trading results, can help you make better decisions about trading, but is not in any way advice or consulting. Today we're going to talk about some trade setups and some various support and resistance targets for the E-mini S&P 500 and natural gas. You can always reach us on Twitter at Kaseco, and you can always reach me personally via email, dean@kaseco.com, or on StockTwits where my handle is at pdeanrogers. Okay, so we'll go ahead and get started here with the E-mini S&P 500, which has risen to a new high over the past few days. Last week we were looking at the market when it fell to this 1968.25 swing low. It looked like it was poised to continue lower. There was some major resistance, or major support that was met right at that 1968.25. So it was a decision point, and the market turned higher, closed up, formed a nice bullish engulfing line, or nearly an engulfing line here the day after the 1968.25 swing low was made, and continued to rise from there so far to 2084.50 swing high, which is pretty close to a 2086 target that we had been talking about for some time. Now this market looks pretty strongly bullish at this point. It rejected this larger move down. We're definitely still in an area of resistance, here right around this 2086. But it does look to me now like this market's going to continue to move higher and move to some of these targets that we've been talking about for the past few months above the 2100 level. So if we look at our analysis here, key aspects of what we're looking for right now is a move to at least this 2111 area. And if it can close above that, then we're looking at this very crucial 2135. Our most important wave right now is this wave up from 1813. This is the most recent major wave that has formed. The levels that we're looking for at this point are up towards that 2132, which connects to 2234 as the equal to target. So if this market can meet this 2132, which is right here, right around this 2136 level plus or minus 5 points, we should start to see it connect to some of these higher levels, specifically this 2236, which is the equal to target. Now in between there's a very important target here at 2213, which is the larger than, or 1.618 projection up from the 665 swing low. When we look at our chart here, and we look at a weekly chart, or even really a monthly chart, if we look at the move up from 665, which is the low that was made back in March of 09, the major wave right now is 665 up to the 1373 down to 1068. So if that is a wave 1 and then 2, and we're in wave 3 right now, and in that situation what you're really looking at is a move up to the larger than target at this 2213, which we could say is within maybe around the 2223 level if you look at a little bit of a wider range, maybe a plus or minus 10 point range. If we looked at that, right in that area, there's a very, very important resistance level and a very likely point at which wave 3 could stall. This is an area that we're going to need to watch really closely here between 2213 and the 2234 as this market begins to advance over the next several weeks, or continues to advance over the next several weeks. I would expect to see a fairly major correction from those levels, and it could take several weeks to get there. If this market is forming a 5-wave formation up from 665, it still needs a wave 4, and something that's along the lines of the same magnitude as what we saw here for wave 2. As far as support is concerned, if we look at the one wave down from 2084, the lowest it projects is right around 2057.60, which is around our first support point of 2055. So it's not a lot, it's almost a 30-point move from where we are right now. We're at 2082.75 at the moment, so about a 28-point move. So that's a big move. But nonetheless, the market doesn't really start to take on the shape of a correction or a potential extended correction until it gets below at least this 2055, which when we look at the retracements of the move up from 1968.25, okay, again, we're looking at the move up from 1968.25 here on the daily chart up to the 2084.50 that has taken place so far, if we look at those retracements, the 21% retracement is right around that 2055 level, 2060. Once it gets below that, we can start talking correction. Until then, I'm not going to get too excited. Right now, from a trading standpoint, I'm really looking for long trades. If I'm taking short trades, they're counter trend. I'm trading those on intraday charts and shorter bar lengths because they're a higher risk trade. If it gets below that, then we're looking at a 38% retracement down to around 2040. And that would be a normal correction. Okay, so a normal correction of the move up from 1968.25 to the 2084.50. If the 2084.50 holds, 2040 would be a normal correction. That's an area that would be a potential stalling point. And again, I'd be looking for a recovery from there, because right now it really does look like this market is going to continue to move and meet at least the 2110 target and try to meet some of those really key levels, the 2234 and 2213 levels. So those are levels that it's going to probably take another couple of weeks, if not months, to get up to these. But getting up to this 2132 is definitely doable in a fairly reasonable amount of time over the next week or two, maybe 3 weeks. Anyway, getting back to the support here, 2040 is an area that I would expect to hold right now. If it breaks that, then you're really looking at a move down, probably towards something. I've got this wider range target, plus or minus 8 points, right around 2020. And the reason that is 2020 is right in here, right around the 62% retracement. That's 2012 of the move up from 1968, and then also the 21% retracement up from 1813, which was the prior last major swing low to 1968.25. So that's going to be the key level. If it breaks 2020, then the market's more than likely going to extend the correction and try to come back down, test the 1968.25 level, and right in that area we've got this 1968.25. There's also going to be this 1981 support right here, which is the 38% retracement up from 1813, and the 89% retracement from 1968. If it breaks that, we're looking at 1950, and then the big ultimate key level is going to be 1916 here, but I doubt we get that low anytime soon. I really doubt we get below 2040 at this point, and the lowest that I could see is going near term without something major happening or changing in the fundamentals of the market would be this 2020 area or 2012 to be more realistic. The key aspect of natural gas this week is that it took out this very, very important swing low of 3129. 3129 was a swing low that took place after the 444 swing high, and was a swing low in late last year, late 2013. So it was in August, first week of August of 2013. That was a really important swing low because it was the last swing low before this major run up to 649.3. Now that run up to 649.3 was a spike due to cold weather last winter, extremely cold winter, one of the coldest on record, and just wide sweeping, cold, brutal winter. And the 649.3 really only took place, that spike really only took place in the prompt months, the winter months of February, March, and April at that time. And April really wasn't even that big of a move. And for the most part, most of the contracts on the forward curve held around $5 or held at or below $5. So you're really looking at a situation where for most of the contracts, this swing low of 3129 or that area was really important because it was the potentially a wave A, B, and then C. Taking out 3129 really kind of opens up the way for the market to fall below $3 and get a two handle. I think a lot of people are really surprised at how bearish this market has been. They're from a fundamental standpoint, there's lots of gas in storage. It has been a very mild winter so far, and that's the key driving factors right now, is that there really has not been any kind of external factors, i.e. cold weather, to come in and really support this market. This one move up that we saw in early November was due to cold weather in the early part of November, but then that subsided and we've seen the market come right back. Now, this is a market that is set up for at least a potential, long term, this market is bearish. There is no question about that in my mind. From a technical standpoint, I think next year, towards the latter part of the year, and it could even be in the early part of the year, we're going to see this market trading with a two handle. I don't expect it to trade with a two handle for very long in the near term, but longer term, getting into summer of next year, especially into the shoulder months of August, September, October, I have right now there's very little reason to think that the market is not going to fall down into the twos and maybe even into the mid to low twos again. We'll see if it can challenge this 1902 swing low that was made back in 2012, in April of 2012. Right now that's a little doubtful, but at this point we've taken out the 62% retracement of the move up. We've taken out the 3129 swing low. We're about to take out the 305 swing low. This morning the low was 3075. Right now at the moment the low is 3056. So we're really looking at a situation where we're probably going to take out the 305 swing low here pretty soon, and then your next major swing low is 257.5. So longer term this market is bearish. However, the moment that we get some cold weather, this market is going to turn back higher, and more than likely, like a rubber band that's being stretched too far, it's going to bounce too high. I'm not thinking that the market's going to go to $6 or even $5 at this point. It will probably be lucky to get back to $4 at this point, but that is a definite possibility. So there may be some long opportunities here in natural gas, at least from a short-term standpoint, or the ETF UNG, to make some a good trade. But the key is going to be watching this market very closely and watching for some of the key aspects that show that a turn is taking place, like divergence. And once we get that, looking at which retracements are being overcome, and then most importantly, knowing when to get out of the trade, not getting greedy, because it will probably be a short, sustained spike, for maybe a few days, few weeks, maybe even a few months if weather is sustainable. But for the time being, this is a market that longer term, again, is going to be bearish. If it can overcome this 454 swing high, then we might have something to talk about. Anyway, let's look at some of the targets that I've worked up. Now, as far as the targets are concerned on the downside, we've got a very important support point, very confluent support point here, right around 298. It has 11 fines, very clearly the most confluent support point right now. There's lots of waves down, but I've really trimmed this down, at least for the perpetual or continuation chart, down to the most important waves. The numbers that I'm looking at here, when I do my analysis on a weekly basis for natural gas, when I publish on the weekends our newsletter, I generally focus mostly on the nearby or prompt 3 months or prompt month contract. But here I'm looking at the perpetual just because I wanted to get a little bit of a longer term view. And so we're looking at 298. That's going to be a really important point. If it breaks below that, we're looking at 274, 259, 239, and then 210. These are all targets that are extremely confluent. Our most important wave down right now is probably from this, the 649.3 down to the 354.1. We might even have a 5-wave formation where we have 649.3, 1, 2, 3, 4, 5. So if we look at that 649.3 down to 4221, you're looking at your equal to target at 261. Your trend terminus is the $1.78. That's getting down towards that $1.90. So if that's a 5-wave formation, that's a possibility. You also have your larger than and intermediate targets. So really, if it breaks this 261, you look at that big wave down, you're really looking at a market that's going to fall to a new low down below the $1.90 that was made back in 11. So, we're going to see. Let's see what happens at this 260 level. The next most important wave that I'm really looking at is this 488.6 down to the 354.1. And so if we look at that wave here, you can see there's 269. I actually probably could have colored this if I looked at the 269 to 256, maybe gave myself a little bit of a wider range, made it 262 plus or minus 7 cents. That might have worked a little bit better, but nonetheless, you can see that there's confluence right in those 260s. That's going to be really important. So that's the key support level right now. If this market can break 298, is right here, right around this 258.8, 260, 262. Like we were just showing, if we widen the range a little bit, we can get at least one more find. But that range is going to be extremely important because once it breaks that, you're looking at a move down towards a larger than target here. If you're looking at the waves down from 454 If we look at the daily chart and we look at the 454 down, we've got this 393 and the 358. And so if we go back and look at our wave projections, down from 454, if we look down to the 393, there's the 298 there. 454 down to the 358, you can see this connection. Once we broke below the 334, smaller than target, we should see at least 298. 298 is definitely a potential stalling point, okay? It's not looking great right now, but this week's kind of a funky week of trading anyway. So we need to watch, and next week might be a little funky because of the New Year's holiday. But next week and the following week, we really need to watch this market closely, because I think a lot of people, when they start coming back to the trading desk, are going to see that this market is deeply oversold. And yes, the fundamentals are there, and the lack of weather, the lack of support is present. I'm not saying that these prices aren't unwarranted, but there's going to be people that seize this opportunity, whether those are consumers buying up to lock in natural gas prices for the rest of the winter, or for even maybe the next 6 months to a year. I know that some of our models are starting to trigger some very early stage hedges for a longer period of time. So you're going to see some people coming in to buy this. And that's why I think that 298 is a potential stalling point. Again, if it breaks that, you're looking at that 261, 262 area, and then there's our 240. All right. So as far as resistance is concerned, these numbers are changing as we're making new lows. But as of this morning, when I was running this analysis, we were looking at 325. Really, we can start having the conversation about a recovery once the market moves above 325. Now, that does not mean that if the market stalls at 298, we can't establish a long trade before it overcomes 325. I would just recommend doing that on a small, short-term intraday chart where we can tighten stops and keep low risk, just in case it's just a little bit of a bump, a little retracement before the next leg down. Once it overcomes 325, I'd have confidence in starting to scale those trades up to longer bar lengths. Or if I'm trading the ETF, even back up towards the daily chart on confirming buy signals. Okay, I want confirming buy signals from Statware, from Kase. The next level is going to be 335, then 345, 365, and 382. Now, I know coincidentally it's kind of every 10 cents here initially and then 20 cents, but that's just the way this morning at least these retracements up from the 454 worked out, and from some of these other earlier levels down from like this 393.6. You can see that 342 is pretty close to the 345, 362, 365, 38% retracement down from 454.4, which is our most recent major swing high. 38% retracement is 365. That's why I'm saying right now there's almost 60% or 60 cents, almost 60 cents of profit that can be made if this market turns higher, and that would still be a minimal correction, a normal correction for the most recent swing down. So there's definitely going to be, I think people are going to start, drooling at the chops a little bit when they start seeing this market and seeing the opportunities, at least to make a short-term, quick buck. All right, so let's watch natural gas real closely. I'm not trying to get too overly enthusiastic about it here. I'm just saying we've got some signals, we've got some warnings, and we've got some setups here. We don't see a lot of signs that this market's going to turn higher yet. There's not a lot of technical factors indicating that yet. But I think this market's being driven lower right now. It's low volume, kind of a funky time of year from a trading standpoint because of the holiday season. And so once these traders get back to their desks, I think that there's going to be some opportunity for this market to move up in a very short period of time, especially and given, okay, it gets some support from external factors, some support from factors like cold weather that will help drive prices higher, at least for the prompt months in the short run. Long term, this is a bearish market, okay? Long term, this is a bearish market. So I'm not expecting that, I don't want anybody to take this as I'm calling for a recovery or I'm calling for a bull market. I'm just saying there's some opportunity here in natural gas that, could yield some nice profits short run if the market can stall soon and can give us some factors come into play that help drive the prices higher in a short-term type of move. All right, so those are things to watch for. Again, watch for the divergences, watch these key levels that we talked about. 298, 274, and especially this 258.8 or 260 level. That's going to be key. I think short run we'll probably see this market stall out somewhere right around 298, maybe a little bit lower than that over the next week or two. So we'll be watching these levels, and if you guys have any questions, comments, or concerns, feel free to call me or email me. My email address is dean@casego.com. You guys can always reach me at 505-237-1600. That's the call center number. You can reach out to us on Twitter @Casego, and you can also reach me on Stock Twits, P. Dean Rogers. Again, thank you for attending. Happy holidays to everyone, and we'll talk to you all next week. Take care.